For this session, we will still talk about your general principles of taxation. However, our main focus now is your limitations on the power of taxation. So, as we have said before in our session, that taxation is generally limited by your inherent and constitutional limitations. So, we will discuss them here in this particular session. So, let's start by talking about the scope of taxation. Generally, taxation is comprehensive. So whenever we say taxation is comprehensive, it can tax any subject matter or any object. Right? So it can tax a person, a property, a right, a privilege, etc. Next, we said it is unlimited. When we say unlimited, again, it is up to the legislature as to the amount that it will impose. So it is unlimited as to the amount to be imposed by the legislature. Next, it is plenary. What do we mean when we say plenary? It is complete. What do we mean by complete? When we say complete, we are not only assessing and collecting. So aside from your assessment and collection, we also provide for remedies. We also provide for remedies. So it is complete because of those items, because the government may avail of different remedies pursuant to our laws here in the Philippines. Next, taxation power is supreme. Taxation power is supreme. So whenever we say taxation power is supreme, it is also a strong power of the government. It cannot be interpreted to mean that it is the superior among all, because we said a while back that sometimes it is inferior, especially to the constitutional limitations. But again, since it is a power, it is also a strong power of the government. That's why it's supreme. The scope of taxation comprehensive because it can tax any subject matter or object. It is unlimited because it is up to the legislature on the amount that it will impose on the subject matter or object. It is plenary because aside from assessment or collection based on the laws, we still provide for remedies. So it is complete in all sense. Aside from collection, we have remedies. Furthermore, it is supreme as a power of the government. Now let's go to the limitations to power of taxation. So what are the limitations to the power of taxation? The first, there are two main categories of limitations. So it could be inherent limitation or a constitutional limitation. Let's start first with your inherent limitation. The first inherent limitation is that it is for public purpose. Always remember that whenever we talk about your taxation, the primary purpose is public purpose. So generally, that is the general welfare of the people. So we try to defray the expenses of the government and for general welfare. Next, we have the exemption of the government from taxation. So of course, the government is exempt from taxes because again, it is the government now who provides for services. So if we try to tax itself, so if the government will tax itself, then it will be absurd. Next, we have non-delegability of the power to tax. So what do we mean by non-delegability of the power to tax? We already talked about this a while back. We talk about the non-delegation of the power to tax. So when we say non-delegation of the power to tax, generally, it is inherent in the legislative. It is inherent in the legislative. However, there are certain exemptions wherein you can transfer the power to tax, let's say tariff, to the president, the power to tax of the LGU as to local taxes. So that is non-delegability. Next, it is territoriality. So when we say territoriality, we can only tax individuals and properties within the territorial jurisdiction of the Philippines. So if ever you are within the Philippines, then we have the obligations uh, pursuant to our tax laws. Next, we have your international committee or treaty. So as a form of our committee to international organizations or to other sovereign states, we don't tax them. So when we say inherent limitation, it means that uh, we cannot tax if in case, or we cannot use the power to tax if ever it is not for public purpose, if ever it is government, if ever it is delegated by or it delegated to other persons, it is not within the territory, or it is part of our committee to the international organizations or to sovereign states. So you cannot use your power to tax. Okay. Next, constitutional limitations. So these are limitations provided by the Philippine Constitution. Okay. Again, when we talk about limitations, it means that you cannot use your power to tax. So we have here inherent, if ever the purpose is not public purpose, then you cannot tax. If ever it is government, then you cannot tax. If ever it is delegated only, then you cannot tax. If ever it is not within the territory, then you cannot tax. If ever that is based on international committee or sovereign states, then you cannot tax. Okay, that's the rule. So if that is a foreign government, generally it is exempt. Take note for international government. So if that is a foreign government, whether it is the agency itself or a foreign government owned and controlled corporation, it is exempt. Take note of this, okay? Again, if it is a foreign government, whether it is the agency of the foreign government or the GOCC of that government, it is exempt. But if that is a Philippine government, from number 2, Philippine government, if that is an agency, generally it is exempt. If that is a GOCC, okay, take note of this, it can be taxable. For example, PCSO, it is a government-owned and controlled corporation. However, it is now taxable. So take note of this. If it is through international committee, the foreign government, whether agency or GOCC, is exempt. If it's through number 2, government itself, Philippine government, the agency, or the department is exempt, but the GOCC is taxable. Now let's go to your constitutional limitation. So whenever we talk about constitutional limitation, these are limitations provided by the Constitution or the Philippine Constitution. So the first one, due process of law. So observance of due process of law and equal protection of the laws. So for Section 1, Article 3, there are 2 items of constitutional limitation: due process and equal protection. Let's start first with due process. So when we say due process, there are generally 2 items of due process. We have substantive and procedural. Substantive and procedural. When we say substantive, it is the law itself, right? The tax law itself. While procedural, it is the procedure in the implementation of your tax law. So generally, this talks about notice and hearing. So therefore, you cannot just collect taxes without proper notice and hearing, or if ever there's no legal basis. So that's why if ever we will go to your remedies, there must first be a notification on the taxpayer that there will be a assessment and collection in the form of LOA, letter of authority. So if there's already a letter of authority, then you can be subject to assessment and collection because again, that is based on your due process. But if not, then you cannot be subject to assessment and collection because again, you must be given an opportunity for notice and hearing. So opportunity to present, of course, and the opportunity to be heard. That is your due process of law. Next, we have your equal protection clause. So when we say equal protection clause, we're talking about object of taxation. We're talking about your object of taxation. So we already expounded on different object of taxation. It could be a person, it could be a business, it could be a right, it could be a privilege. And take note, if ever, whatever type of object, it must have the same, whatever type of object, if ever it is person, the taxation of that person must be the same among all person. So same object, there must be a same taxation. Same object of taxation, there must be a same taxation. That is your equal protection. Again, on the first one, due process, it talks about your substantive and procedural due process. When we talk about substantive, whatever is provided under the tax law. Under procedural, we're talking about procedure as to notice and hearing. So let's say, for example, when we go to your remedies, that if ever you will be subject to assessment and collection, it must follow our tax law that you are really liable for a tax. And it must also follow the procedure that you must be first given a letter of authority, you must be notified. And once there is already a notification, then there must be a hearing. You can protest that and you must be heard. That is your due process clause. How about in your equal protection clause as to your taxation or a limitation to your taxation? It talks about object of taxation. What is that object of taxation? That if ever it is the same object, then it must be taxed the same. So it is equality among the same object. Equality among the same object. If that is a person, it must be taxed based on the tax of a person. If that is a privilege, it must be taxed based on the tax of a privilege. You cannot tax it differently. So it must be equality based on the object. There is no special treatment. It must be equal among all objects of that particular tax. Next, uniformity and equity in taxation. Uniformity and equity in taxation. This talks about proper classification, okay? This talks about proper classification. So for example, a while back, we're only talking about object. An object can be a person. Now, we try to classify that person. That person can be a resident, non-resident, it could be an alien, etc. So when we talk about uniformity, you are now applying a particular class of an object, the same taxation. Class of an object, the same taxation. Ulitin natin. In equal protection, we're talking only as to the object as a whole. The object of taxation must be equal or same taxation. In uniformity of taxation, we're trying now to classify. There must be a valid classification. So in an object, we try now to classify, and in that classification, there must be a uniform taxation. So for example, we classify a person as a resident. Among all residents, there must be a uniform taxation. Are we clear? Equal protection, same object, uniform and equity. We're now classifying the object, and in that classification, there must be a uniform taxation. So taxation of the same class. So taxation of the same class, or normally based on the class. Take note, equal object, Uniform classification. There must be a classification. Next, no imprisonment for non-payment of poll tax. So if ever you are liable for poll tax, so normally you know this one as cedula. If ever you did not pay your cedula, you cannot be imprisoned. You cannot be imprisoned for non-payment of your cedula. But that's the general rule. That's the general rule. But under the law, if ever you are, if you acted in bad faith, you can still be made liable. You can be still made liable. So as a rule, if ever cedula, you cannot be imprisoned. Kulang kasi to, non-imprisonment for non-payment of debt or poll tax. The exception to that rule is if ever you have bad faith. The exception to the rule is bad faith. If you acted in bad faith, you can be imprisoned. Next, non-impairment of obligation and contract. So what do we mean by non-impairment of obligation and contract? So in non-impairment of obligation of contract, if ever there is a law, a tax law, it could not impair the privity of the contracts entered into by persons. Take note again, if ever there is a tax law, it cannot impair the privity of contracts between persons. So tax law, okay, there is a contract. Then there is now a tax law. Generally, a contract must be based on, to be valid, it must be within the bounds of the law, customs, public order, etc. But here, the contract started first, and then there was a law. Now, because of the law, the contract now is considered invalid. Can that tax law operate against that contract? No, because it cannot impair the contract. Why? Because tax laws are prospective. Gets? That's the rule. That's why it's inferior, because again, it cannot really impair whatever has been entered before. Why? Because it is prospective. Unless generally it is retrospective. But even if it is retrospective, because of the constitutional limitation under number 4, then it could not impair. So let's say, for example, um, there is an executive agreement with China. Okay, I will use China as an example. So there's an executive agreement of a joint venture with China. And under that agreement, the joint venture exploration is exempt. Is exempt. And let's say now there is a tax law which now taxes joint venture agreements with foreign entities. Okay, with foreign entities. Can this tax law impair the executive agreement with China? No, because again, of the non-impairment of obligation and contracts. That's the discussion with non-impairment of obligation and contracts. But the main rule here is just take note of this. Tax law applies prospectively. Therefore, if there's a contract before the particular tax law, it could not impair that particular agreement or contract. Next one, we have prohibition against infringement of religious freedom. So this is your free exercise of religion. Free exercise of religion. So under free exercise of religion, you cannot make use of taxation to regulate religion. Free exercise of religion cannot make use of taxation to regulate religion. Okay, so this is considered as a limitation to serve as a protection to exercise your religion. So you cannot just impose higher taxes to religion or impose taxes on religious article, anything that could degrade the infringement or infringe the religious freedom is prohibited pursuant to this constitutional limitation. So you cannot make use again of taxation to regulate religion. One common example is, for example, a religion produces different, let's say, Bible or reading materials, can you tax the Bible and reading materials? Because again, without the Bible and the reading materials of that religious organization, of course, they cannot exercise their religious freedom. So can you tax the Bible? No. Why? Because you will now prohibit or you will infringe their right as to their religious freedom. So that is number 5. Again, infringement of religious freedom. Number 6, prohibition against appropriation of for religious purposes. So if in number 5, infringement of religious freedom, in number 6, we're talking about the government not appropriating for religious purposes. Why? It's because, again, your appropriations generally must be for public purpose. It must be for public purpose. And not the whole public has the same religion. That's why the Constitution does not provide or does not allow appropriation to a specific religion because the government has no specific religion. Therefore, the main consideration must be the public purpose, no appropriations for religious purposes. Number 7, exemption of all revenues and assets of non-stock, non-profit educational institution used actually, directly, and exclusively for educational purposes from income, property, donors' taxes, and custom duties. Okay, remember this one. If ever it is non-profit, non-stock educational institution, what is the exception? The exemption is revenue and asset. Therefore, it is exempt from income tax and property tax. Income tax and property tax. But if ever it is only religious, charitable, or educational institution, property tax only. Okay, again, if ever non-stock, non-profit educational institution, income tax, property tax, including donors and custom duties. But if it's only a religious organization, charitable organization, educational organization, property tax only. Take note of this difference. Take note of this difference because again, we are talking about the exemption. The exemption for non-stock non-profit, mas marami. Religious, charitable, isa lang. Property tax. Next, we have concurrence by a majority of all members of Congress in the passage of granting tax exemptions. So for tax exemptions, what is needed is majority. What is majority? What is majority? It is 50% plus 1. Take note, members of the Congress. Members of the Congress. So when we say, sir, members of the Congress, how do they vote? Do they vote as one? No, you vote separately. HOR and Senate, majority, majority. So majority of both HOR and Senate separately. Okay, I'll just write it here. The vote must be separately. Next, number 9. Congress may not deprive the Supreme Court of its jurisdiction to review, revise, reverse, modify, or affirm on appeal or certiorari final judgment and orders of lower courts in all cases involving the legality of any tax, imposed assessment, or any penalty. We talked about this a while back. If wisdom, non-interference. But if ever we're talking about legality, this is valid. We call that one your power of judicial review. Power of judicial review. That is under number 9. So if ever we try to look into the legality of the tax, the assessment, or the penalty provided by both the legislature and the BIR. Then you can ask the court to rule based on appeal or based on certiorari. We call that your power of judicial review. Next, rule requiring that appropriations, revenue, and tariff bills shall originate exclusively from HOR. To take note of this one, what you need to remember here is tariff bill. If ever it is tariff bill, HOR. Other tax laws, it could be HOR or Senate. Okay, so laws, our tax laws, it could be income tax law, business tax, or let's say it is tariff. Income or business, it could come from HOR or Senate. But for tariff, it should be purely HOR. Okay? HOR. How about other revenue bills? Other revenue bills, let's say purely revenue bills, then it's still HOR. Okay? But if ever it is not revenue or tariff bill, saan? HOR or Senate. Okay, lagay na lang natin dito. If ever it is revenue or tariff bill, HOR, not revenue or tariff bill, it could be HOR or Senate. Next, number 11, power of the president to veto any particular item or items in an appropriation, revenue, or tariff bill. So let's say there is now a revenue or tariff bill. The president can veto. Okay, it could be an item veto or the packet veto. What's the difference? An item veto, let's say there are different sections, right? Let's say the tariff bill has 33 sections and the president does not like section 25. We call that one item veto. Tatanggalin yung section 25. Just like in your create or in your train, some items are vetoed, right? So there are items that was removed because again, the president could veto it or could remove it. Or a packet veto. In short, the whole bill is not approved by the president. So the president could veto it. Next, freedom of speech and of the press. So this is now non-impairment of the freedom of the press. So what do we mean by this? If a while back, freedom of religion, now it is freedom of the press. What do we mean by this? You cannot use taxation to regulate religion or the press. So let's say, for example, you will tax all of the different multimedia corporations here in the Philippines at 90%. Is that valid? No, because that is impairment of speech or of the press, impairment of the press freedom. So take note that if ever you will use taxation to regulate religion or press, then that's invalid. What I want you to remember on the constitutional limitations, the most important one, the difference between equal protection and uniformity. Equal protection, one object. Uniformity based on classification. Another, the difference between, non-stock, non-profit educational institutions and religious or charitable educational organizations. So there are different exemptions for non-profit, non-stock educational institution. It is income, property, donors, and custom duties. While for religious, charitable, and educational institution, it is only property tax. Furthermore, take note that tax bills and tariff bills and revenue bills must come from HOR. It must not come from Senate. For exemption, there must be a majority. When we see majority, it must be separate voting. Separate voting of the Senate and HOR. Now, since we talk about taxation, we talk about the different limitations of taxation, then what are the elements of a valid tax? The elements of the valid tax are as follows. It must not violate the constitutional limitations we discussed, the inherent limitations we discussed, or contractual limitation. What is this contractual limitation? So when we talk about contractual limitation, this is non-impairment of obligations and contracts. You have already known that if ever there is a tax law, it could not operate prospectively, or it could not impair what have been entered into before the passing of the tax law. Next, it must be uniform and equitable. What do we mean by uniform and equitable again? It is based on the classification, proper classification. And based on the classification, then there must be no special treatment. There must be equality in treatment. Therefore, it must not be unjust, not excessive, not oppressive, not confiscatory, or discriminatory. Next, it must be always for public purpose. And we already elaborated on what is public purpose. It could be the general welfare, or to defray the expenses of the government, or anything for the public. Number 4, must be levied by the taxing power, in short, by the legislature, having jurisdiction over the object of taxation. Take note, it can only be levied within the Philippines. Next, it must be proportionate in character. So when we say it is proportionate in character, this is based on your method or mode of cost allocation. Do you still remember that? We try to connect the mode of cost allocation on your lifeblood theory, on your aside from lifeblood theory, benefit received theory, and ability to pay theory. Okay, I hope you still remember that. And lastly, it is generally payable in money, because that money will be used to defray the expenses of the government or for public purposes. As a rule, it is only payable in money. Okay, as a rule, it is payable in money. But take note that even if it is payable in money, there are times that if in cases the taxpayer cannot pay using money, the government can accept properties. The government can accept properties. So that's for generally payable in money. So elements of a valid tax. Take note, you can only discuss these elements of a valid tax once you understood the concept of taxation and the limitations of taxation. Now, let's go to the concept of double taxation. A double taxation can be either direct or indirect double taxation. Direct or indirect double taxation. So what is direct double taxation? So when we say direct double taxation, if ever the same taxpayer is taxed twice when he should be taxed only once for the same purpose, same taxing authority, same jurisdiction, same taxing period, and same kind or character. Okay? Ulitin natin. Direct double taxation when the same taxpayer is taxed twice for the same purpose, same taxing authority within the same jurisdiction, same taxing period, and same kind of character. So what are the requisites? The following are the requisites. First, it must be same taxpayer, same taxpayer, same purpose, taxing authority, same jurisdiction, same taxing period, and same character. Okay, so we have that. We have double taxation, same taxpayer, purpose, taxing authority, jurisdiction, taxing period, and same taxing character. The primary element here, indirect duplicate, is the same taxpayer or object. Okay? Primary element is the same taxpayer or object. If ever it is same taxpayer or object, then yan yung primary element mo. Ang secondary element mo na lang ay yung purpose, taxing authority, jurisdiction, taxing period, and character. So if ever all of these items, if the primary and secondary is present, we call that direct double taxation. But if only the primary is present, but the secondary is absent, then we call that one indirect. And if ever it is direct, it is invalid. Okay, why? Because it is unconstitutional. But if it's direct, indirect, if indirect, it is valid, therefore it is constitutional. Why is it unconstitutional? Remember a while back that taxation must not be oppressive, confiscatory, discriminatory, etc. In short, uh, it must be uniform and it must be equal. So we said that a while back. Therefore, if ever it is direct duplicate, it is not now equal. It is not uniform. Why? Because it is now confiscatory. Paulit-ulit mo nang tinatax eh. So that is considered unconstitutional. But if ever it is indirect, only same subject matter, but the secondary elements are not present, that is valid. Why? It could still go through our constitution. It will still go to our constitution. So it's valid, it is constitutional. So whenever we talk about double taxation, what you need to determine first if the secondary elements are present. Taxing authority, period, jurisdiction, purpose, character, etc. If all of those are present and same subject or taxpayer, then it is direct. If not, then it is indirect. So generally, for indirect double taxation, we also have this so-called international double taxation. But perhaps we will talk about that in the future when we go to your preferential taxes. We can claim for tax exemption, tax credit, reciprocity, etc. But those are just some ways to remedy the indirect double taxation. But we will expound soon when we go to your preferential taxation. So again, double taxation, just look for primary and secondary elements. Now let's go to your different escapes from taxation. So what are these escapes from taxation? So for escapes from taxation, generally what we look before is we we only divide it on different items. So what are those different items? So we try to divide it whether it is evasion or avoidance and incentives. But we will define it now as a whole. So the different types of escape, we will not classify it. So let's start first with tax evasion. Tax evasion is also known as tax dodging. So whenever it is unlawful, it is tax evasion. Okay, just take note. The word here or the term that you need to find is it is unlawful. Once it is unlawful, tax evasion. Now we go to your tax shifting. For tax shifting, it is the process of transferring the tax burden from the statutory taxpayer to another without violating the law. Therefore, this one is lawful. However, we transfer from one subject matter to another subject matter. Some examples here are indirect taxes. What are indirect taxes? So for example, VAT, the business transfers the VAT to the consumers. That is known as tax shifting. Next, capitalization. It generally occurs at the time of selling process or exchange or transfer of the land or other assets which generate a flow of income and are subject to a series of successive annual taxes during their lifetime. So this talks about instead of expensing an item, you create an asset, so you capitalize it, and you will just amortize or depreciate it as it passes by. So for example, one of the common example here is an item of your income taxation for leasehold improvements. Okay, income from leasehold improvements. So you can account for it outright, or you can account it spread out. So if you do it outright, then it's more of capitalization. But if you do it outright, it is not capitalization, by the way. It is not capitalization. Why? Because you will expense it outright. But if it's spread out, you are now subjecting it to a series of annual taxes because you are spreading it out. So this is a form of capitalization. So again, an example here is your leasehold improvement. If ever it is outright, then you do not capitalize. But it's spread out, you will now subject it to successive annual taxes, then it is capitalization. So in your capitalization, what you need to remember here is instead of expensing it or recognizing it outright, then you would want to recognize an asset instead and divide the value of that asset over its useful life. That's capitalization. Next, we have tax avoidance. Tax avoidance is also known as your tax minimization. So under tax minimization, this is again a saving device. However, it is sanctioned by law. If tax evasion is unlawful, tax avoidance is valid or it is lawful. So legal, permissible means. Legal, permissible means. I'll give you an example. So let's say CGT. Let's say CGT. So for CGT, normally, if you are the buyer, let's say this is a buyer, okay, seller sold the property to a buyer. There is a CGT here, right? So assuming the buyer is considered as a dealer, is considered as a dealer. Based on actual practice, what I normally tell my clients is that um, seller, and then here is the buyer. The buyer will only create an SPA, so there is no sale here. And once the buyer will sell it to a third person, there is now a sale. So if that is normal sale, there will be a two types of tax, or the property is taxed twice on the first transaction and on the second transaction. But if that is only an SPA, sale, then there is only one tax. So you minimize one tax from the first one, right? So that is known as tax avoidance. And now, if ever the buyer will place in the contract that it will now be the seller to it is the duty or the obligation of the seller to pay the CGT, that is considered as shifting. Again, a valid way, a tax avoidance scheme. So valid way, but you now reduce or totally escape the payment of taxes. So in our example, on the first one, SPA, there's the first, instead of sale, it's more of an SPA, then that cannot be taxed because in SPA, generally, it's more of an administration, not a transfer of right. Then upon the sale of the buyer of the property to buyer, from the buyer to the third person, then there will be now a CGT. And if ever you will place in your agreement that you will now shift the taxes to the third person, then that's again a valid escape of taxation. We call that shifting. The first one is minimization. The second example is shifting. Next, transformation. Transformation is the effective application of organizational design, process improvement, and enabling technology to improve data integrity, tax function efficiency, and performance while driving value for the business. So, what you need to remember here in your transformation is that you try to absorb the additional taxes. Okay, there's a tax. There is a tax. You absorb the tax. So the loss on the tax will be used to and try to change your operations or improve your operations so that the loss on that particular tax which is absorbed will be covered by your transformation. So for example, um, you have a tax of 20,000. Then you try to improve the process so that you can absorb the 20,000 loss. And in improving the process, you will now decrease the cost. So you try to transform the loss by decreasing your cost. Therefore, in short, parang wala ka ring binayaran na tax kasi you transform the cost as a saving. Okay? You transform the cost as a saving by absorbing the loss. Last type of escapes from taxation is your tax exemption. Your tax exemption is an immunity or privilege, freedom in the payment of tax. We could also call this one as tax holiday. Tax holiday. But take note, it doesn't mean that if you are exempted, you are exempted to all types of taxes. So it is important, guys. It is important for you to determine your exemption, whether you are only exemption to certain items or exempted to certain items or exempted to all. So it does not mean that if you have a certificate of tax exemption, exempt ka na sa lahat ng taxes. It is only, you look into the certificate of tax exemption on what taxes you are exempted. So those are the escapes from taxation. Lastly, we try to compare amnesty and condonation. So in your amnesty, it is a limited time or offer of the state to a specified group of taxpayer to pay a defined amount. To pay a defined amount. Here in your amnesty, the most common example here is the amnesty on the estate. Amnesty on the estate. So what is this amnesty on the estate? So within the law, whatever are the taxes due based on the different estate or the different succession of property is now decreased on a defined amount. So instead of taxing them on the whole amount, it is now only taxed at 6%. So for example, a person died last 1953. So whatever is the tax in 1953, yun dapat yung babayaran. Pero dahil nagkaroon ng amnesty, ang babayaran niya na lang ngayon ay 6%. So na-decrease. Tapos, baka i-waive pa yung mga penalties. Yeah, they actually waive the penalties. Now, for condonation. For condonation, it is the remission or desisting to exact taxes. So, in condonation, wala ka nang i-collect. In amnesty, may i-collect ka pa din. So, babawasan lang sa amnesty. So, you will only decrease the tax in amnesty. But in condonation, you will not collect anything. So, for example, the tax due is 600,000. In amnesty, let's say, you will only collect 10%. But in condonation, you will now condone. In short, you remit, you refrain. If you remit or refrain, then you will not collect the whole 600,000. That's tax condonation. So that's it for our constitutional and inherent limitations, including your double taxation.